The inflation issue comes from two parts, really. First of all, if you spend a lot more than you earn and you give a lot of money in credit, you're going to have an inflation. But it also comes from the supply-demand of bonds. So if you look at who's benefiting in this, the household sector, the workers, are benefiting. This isn't a classic recession in which the unemployment rate goes up, because the unemployment rate is remaining relatively good because there's wealth transfer, and you have, and they are also having higher wage gauges. And then you have the inefficiency of the global supply chains, which happens there. So what that means, I think, is that you have this stubbornly high inflation. We're not going to go down to our targets for a number of reasons.
America's economic troubles are going to get worse thanks to a debt crisis and looming balance sheet recession, legendary investor Ray Dalio said Wednesday. Speaking at the Bloomberg Invest Conference in New York, Dalio, who in 1975 founded Bridgewater Associates and built it into one of the world's biggest hedge funds, issued a warning that the U.S. economy was facing a risky situation. Dalio told Bloomberg's David Weston one of his concerns was that there may not be enough buyers for an influx of government debt on the market. The U.S. Treasury is expected to issue more than $1 trillion in T-bills by the end of 2023 as the government looks to build its cash reserves following a last-minute deal to raise the debt ceiling. In my opinion, we are at the beginning of a very classic late big-cycle debt crisis when you are producing too much debt and have also a shortage of buyers, Dalio said. According to Dalio, the debt market is at the brink of finding out whether it will have sufficient buyers for an impending influx of Treasury bonds, with the veteran investor arguing that the supply and demand picture will become clearer over the next year or two. There's a lot of debt. It has to be bought. It has to have a high enough interest rate, Dalio said on Wednesday. But if we continue down this path in terms of what's likely over the next 5-10 years, you reach the point where that balancing act becomes very difficult. Let us now get into the video as Ray Dalio succinctly breaks down the present economic situation, the debt crisis, and accompanying geopolitical influence.
There is a debt cycle. There are short debt cycles. We're used to those. They last on average about 7 years, give or take about 3. And you have recession and interest rates are low, inflation is low, and the Federal Reserve becomes stimulative, and then you have growth. You have non-inflationary growth, and you have inflationary growth, and they tighten monetary policy, and then you have the slow up or the recession that follows until the cycle participates. It happens that way. We've had 12 of those. We're in the 13th. We're about halfway through that cycle. We're at the point where interest rates have to rise. Okay, so the level of interest rates, you have to satisfy a debtor and a creditor. And so that means interest rates have to be high enough that the creditor gets a real return, higher than their money. And if you don't do that, you create the cycle that we have before, where money is essentially free, interest rates are nil, or in some cases negative, and you have a situation where you don't have to pay principal, so money was essentially free. Then that imbalance is enormous, and it's made more enormous because even then the supply-demand is not adequate. There's not enough demand to buy those bonds, and so the Federal Reserve's got to come in there and print money and buy those bonds and redistribute wealth. So you have that. So now we have moved to a level of real interest rates. Think about inflation. That is, depending on how you calculate, if you look at tips or if you look at short-term interest rates, they need a 1 to 1.5% real rate. Those days that we have seen in the past are over, and there's a big adjustment in that. So the headline for that is, so who have been the losers? Who have been the winners and who have been the losers? This is a different kind of debt problem, in that what happened is, in order to create this big transfer of wealth that there needed to be in various ways, the government borrowed a lot of money because they spent a lot more than they earned, and they sell a lot of bonds. And then the Federal Reserve buys bonds, and it subsidizes those bonds. And so the big losers of this cycle has not been the individual balance sheets, because the individual balance sheets have been improved. It is the fact that those who are holding government debt are the ones that are having the losses. So the central banks have all lost a lot of money. The commercial banks bought a lot of these debts. So when we look at the commercial banking problem, it is largely a government debt problem because there was the financing of holding bonds with short-term interest rates, and so that was the squeeze. So you have that particular dynamic. As we move forward, the higher you raise the debt to income ratio, the more difficult that balancing act becomes. And so we're seeing a trade-off now that interest rates have got to be high enough for the creditor, but not too high for the debtor. And so you're seeing now this adjustment in which you're having sort of a 1%-ish growth rate, not the household sector having a problem, but those who are holding the bonds and so on, they're having the problems. And so you're seeing growth come down with still an inflation issue.
Dalio also said that political division in America was creating economic risks, arguing that the only good outcome for the political system and the economy was for a strong middle ground to be established even as extremism and a split was growing in both the Republican and Democratic parties. The Bridgewater founder, who has an estimated net worth of $16.5 billion, went on to argue that the economy would be strained for some time because interest rates were now at a level that they're probably going to stay at for a while. The consequences of that are going to be a weaker economy going forward, he said. It doesn't have to be a big downturn because of the household sector, but it is a balance sheet kind of recession. I think things are going to get worse in the economy. There's a financial issue at the same time as you have this internal conflict, so I think that's going to make for a risky situation, he said. Let us continue with the video as Ray discusses the debt crisis and geopolitical influence.
In my opinion, we are at the beginning of a very classic late big cycle debt crisis when the supply-demand gap, when you're producing too much debt, and you have also a shortage of buyers. What's happening now as we have to sell all this debt is we then do have enough buyers. There are changes now in terms of the quantities in the world that are being held by large investors around the world that have lost money in these treasury bonds and so on. And then there are geopolitical changes which are having an effect. Some cases, some countries are worried about sanctions, and then there's this geopolitical shift. So when I look at the supply-demand issue, there's a supply-demand issue for that debt. There's a lot of debt. It has to be bought, has to have a high enough interest rate. So a crisis, that's, if we continue down this path in terms of what's likely over the next, 5 and 10 years, then you reach the point that balancing act becomes very difficult. The things that you see happen over and over again when you look at history is when you have a financial not good situation. At the same time as you have large wealth gaps, you start to see the emergence of populism, and we see extremism in both of the political parties. Okay, we see that split. A populist is an individual or a leader or a political person who will win at all cost, that the rules of the game don't as much matter. And so we're in the January 6th type of incident and so on is very interesting. The political system in terms of primaries and the parties tends to create that sort of polarity. I think it's very clear that there is only one good outcome, if we can, and that's a strong bipartisan middle, because either of the extremes is not going to be able to be dominant. The small right, or even the small left, and as a result, we're seeing a fragmentation. Geographically, you're seeing people move to different areas, not just because of taxes, but of differences in values and so on. And so you're seeing this separation. I think over the next 2 years, the real question is, can we have a strong bipartisan middle, or are we going to have that kind of fragmentation? We have three things aligning that are concerning. On this short-term debt cycle, I call it, the 7-year cycle, we're about halfway through. In other words, interest rates are now at a level that they're probably going to stay at, but they're probably not going to rise much from here, and there's tightness. And the consequences of that are going to be a weaker economy going forward. It doesn't have to be a big downturn because of the household sector, but it is a balance sheet kind of recession. And I think things are going to get worse in the economy. There's a financial issue at the same time as you have this internal conflict. So I think that that's going to make for a risky situation, particularly then when we deal with the third major influence, which is this conflict, this geopolitical conflict in the world, particularly related to China, Russia, and the implications that has on supply chains, production, and the like.
Dalio has been sounding the alarm on the U.S. economy for some time, warning in late 2022 that ridiculously stupid economic policies had the country headed toward a perfect storm of economic pain. He isn't the only market watcher to be concerned about the U.S. economy, even as some investors are feeling more optimistic about the economic outlook amid signs of resilience. Earlier this week, Deutsche Bank warned that America was headed for a policy-led recession, while billionaire investor Stan Druckenmiller said last month that the U.S. was on the brink of a recession and predicted a hard landing. The United States narrowly avoided a default when President Biden signed legislation on Saturday that allowed the Treasury Department, which was perilously close to running out of cash, permission to borrow more money to pay the nation's bills. Now the Treasury is starting to build up its reserves, and the coming borrowing binge could present complications that rattle the economy. The government is expected to borrow around $1 trillion by the end of September, according to estimates by multiple banks. That steady state of borrowing is set to pull cash from banks and other lenders into Treasury securities, draining money from the financial system and amplifying the pressure on already stressed regional lenders. To lure investors to lend such huge amounts to the government, the Treasury faces rising interest costs. Given how many other financial assets are tied to the rate on treasuries, higher borrowing costs for the government also raise costs for banks, companies, and other borrowers, and could create a similar effect to roughly 1 or 2 quarter-point rate increases from the Federal Reserve, analysts have warned. What are your opinions regarding Ray Dalio's insight on the state of the economy? Let us know in the comment section below. Don't forget to hit the like button, subscribe, and turn on notifications. Thanks for watching.